what an interesting time in terms of the direction of the grain markets, and of course we're trying to gauge the impact, the effects of the COVID-19 pandemic on the U.S. economy and the spillover effects onto agriculture. So I think what we'll talk about tonight will be a focus on the main crops, the primary crops that we're growing in Kansas: again, corn, grain, sorghum, wheat, and soybeans. So we'll look at some of the information that came out of the USDA report on Tuesday, May the 12th, and I guess we'll cast a scrutinizing eye on some of the numbers, and if anything, try to identify the likelihood of movement in some of those numbers if that is to occur. So with that, we'll move forward. I do want to talk about just a few macro things. Again, and Brian and colleagues have talked about, Brian Brigham and colleagues have talked about the trends in the market. Again, so the health of the U.S. economy, long-term, short-term, and long-term, has a lot to do with the grain markets, and particularly the feed grains, as they're affected by ethanol production. So from the darkest of days in terms of public sentiment and market sentiment, we've seen some recovery on the Dow Jones Industrial Average, and the U.S. dollar was also really extremely volatile during that time frame. Has come forth and moved to the higher side. I don't know that you can say with our increasing balance sheet in national debt that's jumped up to try to forestall this economic challenges that we have, that we're necessarily in great shape. But we do have the U.S. Federal Reserve standing behind the U.S. economy, and to the degree there are any safe haven currencies in the world, I guess the ability of the U.S. to stabilize the ship is attractive. And of course, higher dollar indices have a lot to do, or have a primary impact on the competitiveness of U.S. grain exports, particularly for wheat, somewhat for soybeans as well. We're watching oil futures because we're worried about ethanol, and the shutdowns in ethanol plants that we'll talk about here in just a little bit certainly have affected the market outlets, the expectations of demand for corn, and we'll look at that. We'll try to put numbers to that as we head off into the corn outlook. But I guess if we're looking for rays of light, something positive, at least it's not going down anymore. And you do hear of some news in the market that after shutting down and whittling down stocks a little bit, that as consumers begin to drive, that demand would come back for gasoline, and ethanol would be with its niche in that, would be pulled forward. So we'll talk about that in a little bit more depth in a minute. Gasoline prices following pretty similar move as for corn. Excuse me, well, I guess as for corn too, but also for oil. You can see they've come up. I do have the weekly retail gasoline and diesel prices for the U.S. This comes from the Energy Information Administration. And again, I don't know, we're not seeing any big recovery yet, but these trail by a few days, so we'll see where gasoline prices go. I know in our local communities we haven't necessarily seen anything charged to the higher side. And gasoline, ethanol futures, pardon me, had bottomed out and have started to move a bit to the higher side. We're not chartists here typically for universities, but it's good to be aware of where market prices have been and such. It sure is noteworthy that we hadn't broke below $1.20 per gallon on ethanol for years and years and years, at least by this chart, all the way back to about 2004, early part 2014 and into 13 fall. But we broke below that, are now seeking to come back to the higher side. So I guess it'll probably be a demand pull situation that makes all that happen. I just am reminded of how ADM closed down the Cedar Rapids ethanol plant and the one in Columbus, and those are two of the largest ones in the country. So, and their stated intention when they closed them down was that they do it for 4 months. Well, that is what they had acted on. However, I would think if demand comes back strong, 4 months could be cut short. But anyway, that was their stated intent at that time. Do you want to talk about corn and sorghum markets? So we have, I guess the key points in the corn market would be, of course, ethanol corn use at risk, damage to the U.S. economy. This is no news to anybody now that's been following this. Decreased fuel demand. We were at one time talking about the oil price war between the Saudis and the Russians, or USSR, but that on the front end sure did not help anything in terms of price movements. So the two of them together, two of those factors together, had conspired to affect this. And I remember those discussions that had taken place, that there was an agreement to scale back the flooding of the market, but that wasn't going to start until May 1. So when the last time we spoke on these issues, we were right in the midst of it and nobody cut back yet. So perhaps now we're starting to see some light at the end of that tunnel. When you, just by the USDA's numbers on their on the May WASDE report, World Ag Supply Demand Estimates, they basically showed a 400 to 450 million bushel reduction in corn use in the old crop supply demand balance sheet for the 1920 marketing year ending August 31st. So, but then the surprising thing to me was that they came back so strong with their numbers and forecast, I think, 5.2 billion bushels of corn usage. So that's basically about 85, 90% of where we were before, and moving, or 95%. So there's a lot riding on this. I'm going to show you a sheet here later. I had, within the last two weeks, I've had two sets of supply demand scenarios. One for what the USDA is talking about, and another about 1 billion bushels lower corn use, or 750 or so. And it's all the difference between $3.20 corn that the USDA is talking about and something 250 to 40 to 70, something like that. So without the recovery, the corn market's pretty much destined to languish, if that's a proper term to use. Now, and we did see, I've talked about it in one of these COVID sessions, about how the DDG reduction in production that occurred was being offset by increased direct corn usage in feed rations. And you sure saw that in particular in the April WASDE report. So to some degree, you've got that, and 400 to 450 million bushels less corn usage. If you take a factor of about 30%, so what's 30% of 450 million bushels of corn? Well, it's about, let's see, half would be 200. So you're talking about 100 to 200 million bushels of corn, compensatory corn or grain sorghum usage, probably corn now. Planting prospects, USDA, the USDA stayed on script. By that, they're not prone, especially with an acreage report coming at the end of June, to make any changes to the prospective planting report numbers that happened at the end of March. So they stayed with their, in essence, 97 million acres planted number. Now the post-report market expectations are that those things are still going to come down. And that conundrum is that we've had dry conditions and great planting weather in most of these areas. There's still some challenges up in the northern states, I understand, but we've heard nobody talking about cutbacks. I saw an analyst today, kind of a lone wolf analyst, saying, I still think it's going to be 94 million acres. But If that's to happen, we it doesn't we don't see the evidence of it. So it adds an element of uncertainty to that coming end of June acreage report. And when you look at estimated production and stocks, so they plugged in 97 million acres, didn't change it. Plugged in also 178 and a half record high corn yields. And of course, when you do that, you're looking at over 15 billion bushels of corn being produced. Ending stocks, unheard of numbers. That's not a misprint. That's 3.3 billion, 22% stocks to use, and a price of $3.20. That 320 is down from 360 in the April report. So again, I've got some thoughts on that, and we'll come back and talk them in a minute. Now, here are a number of slides. I'm just going to show you quickly. But first of all, there's this acreage number. This is an unknown. There should be a question mark on that figure in terms of where we end up at. We were a lot bolder about 3 or 4 weeks ago, saying, "Gosh, we cannot end up with the ethanol demand so damaged." There was every thought that we'd see corn acres drop 4 or 5 million acres. But I think something happened in the meantime. I personally put out a supply demand set of numbers and forecast prices based on that. With ethanol usage being cut down about 20%, basically at the loan rate or above, and felt so bad about it. I'm thinking that I did not just give people no hope whatsoever. That Monty Vanderveer and I dug into the corn, basically took a deeper look at the net of price protection. I don't want to call it safety net. That brings up all these other thoughts. But to look at where price protection really starts to kick in by the time you take into account crop insurance, marketing loans, crop insurance for pre-harvest to harvest coverage, marketing loans for harvest sales, and then in essence, looking at PLC, price loss coverage for harvest to post-harvest coverage, and then a reference price of 370. And what's kind of hidden in there are the deductibles. You get paid for 85% of your production, basically. For PLC, for crop insurance, you're taking depending on what you choose. A lot of people in Kansas, 70 or 75% APH crop insurance. So those lofty numbers, 388 D's corn, 370 revenue protection. By the time you take the deductibles, you end up at about $3, $2.90 to $3 to $3.10. It's just amazing that is basically where the USDA put their number. So there's more price protection out there than the marketing loan. So what did farmers do in the midst of all this uncertainty? To some degree, they looked at their safety nets, it seems, and decided to go ahead and it would not be surprising that they said, well, I've got coverage at 388 D's corn, got the reference price there at 370. I'm gonna count on that to keep me from just falling all the way to disaster on prices. So, being the good, effective, profit maximizing risk managers that they are, it seems that's very likely the direction we went into. And there's the record high yield, 178.5. Yes, you could argue that's a trend yield, but what I think that does, it opens the door wide open to consider what outcomes would be with more average yield outcomes. And we're starting the year not with just sterling weather, pretty dry. It's great planting weather, but a lot of uncertainty to deal with before we christen 178.5 bushel per acre yield for the U.S. this year. And again, following the USDA's projection, there's a 15.995. That's the correct number for the USDA's projection for this year. So 16 billion bushels of corn. would be a lot of corn. 18 some ending stocks. You run those through the balance sheets, and you can see in kind of over time, you see the growth in usage, etc. Corn ethanol sure stands out there as a growth aspect of it. DDGs for livestock feed coming into play for sure, both the green and darker green. Projection of 3.3 billion bushels of carryout, and with that, that is in no way friendly to prices. I do want to talk a little bit about ethanol. Latest numbers that I had access to through the Energy Information Agency, you can see the abrupt shortfall in ethanol production. And when the Renewable Fuels Association came out and said that 46% of ethanol productive capacity was idled, so not going well. You know what? You look at that line where it dropped from, where it dropped to, that it hits right on. That's on the lower blue line, the weekly stocks, weekly production. The production. The stocks in the darker purple had jumped up, had come back down. So we're not short of stocks, but in the logistical flow of ethanol in different parts of the country, it'll be interesting to see which plants in which parts of the country open up because of localized logistics and demand pull in their area. So there's some hope on that. A little bit deeper into ethanol, you can see the prices offered today at plants. Even with all the roughness in ethanol profitability, you can see we still have some positive basis bids for corn. They're not outstanding prices, but the basis bids are positive for another number of places. And here in Kansas, our top bid, 10 over the July contract, 328 is, I think, that's the highest bid in the country for corn. So, and also you see and that's 10 over for corn. For grain sorghum, it's even money with futures. We're in an area where we have very, very positive basis for at ethanol plants for feed grains still. And you can see in Kansas, we're dancing around $1 a gallon for ethanol. And I think a 30-cent jump in that would do a world of good for ethanol markets. And you see DDGs, the Kansas modified 55 or probably 65-70%, from the plant. We're looking at $48 to $62 on average, $58.80, and that's competitive with a lot of areas in the Dakotas, places where there are dairies. Wisconsin, 48, surprising. Wisconsin's not higher given the dairy pull. But so anyway, you see that the corn demand's still decent, and there are moving markets for ethanol. For DDGs. You see that whipsaw trend in the Iowa distillers grains 10% market. Again, when we first tightened up, I gathered dairies, other users were jumping to get hold of what they could. So that strong elastic jump to the higher side for distillers grains prices, and some of that is dissipated now. And you can see what corn prices have done, what ethanol prices have done. But and Glenn, I'm dancing into your area in terms of where that demand pull came from, but I gather it was dairies in large part that were part of that big run up, and since then we've moderated that to some degree. Just want to finish up here for corn. So we're staring at a year where we don't have great pricing prospects because we jumped to 22% stocks to use. The USDA's projected a 320 price, and I am we probably have 3 USDA representatives on this call, and I'll probably catch heck for this. I think when you see what prices they put on things, it's kind of caution first. You know, you look at supply demand, stocks to use relationships. 22% stocks to use could take you a lot lower than 320 prices, but we shall see. So I took a look at these and came up with some alternative scenarios for corn. And there's in the second column of numbers, the items in the 2019-20 stocks supply and demand balance sheet. There's about 80%. There's about 80% chance, 4 out of 5, that'll happen. And what else could happen, we don't know. But that's the best thing out there. But you have these other scenarios here. If you look at the USDA's scenario number 1 in the blue column, right down the line, exactly what they talked about, 320. But it's very likely that some of the thoughts that low corn prices will have caused some switches to be expressed. Kind of timidly put 95 and a half. I was a lot bolder in saying it, basically a million less than that at 94 and a half until some of the recent news came out. So 95.5 million acres seems like a decent way to look at things. I would contend with just dialing in a record high corn yield of 178.5 bushel per acre. There are at least a couple other scenarios of moderate yields to 168, which would be a yield like this year, but it's not a high probability, but still needs to be considered for potential market prospects. And if you start coming off the 178, then you're down. Still, there's so many acres that you're still around 14.7 to 15.1 billion bushels of production. Saying the USDA is right, if you get the ethanol, they plugged in 5.2 billion bushels. Maybe that's good. A week earlier, I plugged in basically 1 billion less, and those numbers down there that are already looking amazingly large for ending stocks at 2.9, 3, 2.4, 2.0. Just in essence, you add about 900 to a billion to them, and then you're awash with corn. And those prices at the end, they're down at they're below $3 a good ways, closer to 250, 270. So it is what it is. And so the key question that the livestock people would like to know again is how quickly will ethanol production come back and to bring about all that much more supply of DDGs. And I personally, I would be optimistic that as much angst as there is in the country about sitting still and not doing anything, that one thing we can't say is that there's not any public pressure to get going. And when they get going, they'll be traveling. So we're in the midst of an issue that's a political health issue having to do with how quickly we're going to be able to move through. So there you see some of those different scenarios, and generally some price increase, but I guess I'm as cautious as the USDA is. I do want to talk about in terms of world supply demand, strong usage, etc. Some issues we could talk on in terms of different countries. I talked about sorghum. If there's less corn acres planted in these Western Corn Belt states, you've got to wonder if people took a look at the strong basis, relatively strong exports for sorghum in these drier areas where where the U.S. Drought Monitor map is showing really dry, that we'd see like a 250,000 increase in grain sorghum acreage, and that coming from corn. We shall see. You can see that because of Chinese policy changes and worries about building up stocks as COVID-19 ravages their country, you can see for exports that we've whereas we had a really down, rough year 2018-19, we're rebounding almost back to where we were in 16 and 17, not quite to the stellar years of 14 and 15. And you can see exports had been really dragging along, but starting to pick up some on a weekly basis in terms of cumulative exports here of late. And so here you have grain sorghum. What does it take for grain sorghum to dissociate itself from corn? Well, it takes a unique demand, and there's the potential, if grain sorghum exports continue, that you'll start to see some of that uncoupling. Boy, you sure see the stocks to use going in different directions between corn and grain sorghum. So as of yet, the USDA's projection pretty tepid, really, in terms of prices, but that could be low. And again, you can see different scenarios that we had put in there, and just an explanation of where that had come from. Basically, both higher acreage, planted acreage, and the eventuality of the USDA maybe probably being too low for where export demand could go for sorghum. Take a look at soybeans. Strong soybean meal markets, and still issues to deal with in terms of COVID-19 and government tax disruptions in Argentina. Some reduction in that Brazilian soy crop size. Again, dry in the southern part of the country, the northern part doing pretty well. So some reduction, but they generally strong crop. And depending on who you listen to, they put in a pretty good Brazilian number. As long as those Brazilian supplies can make it to the ports, given their weak Brazilian real, they're in the front of the line ahead of U.S. soybeans. But eventually they run out, and after that we'll be waiting in the U.S. to pick up on business. Planting prospects. The USDA hung with their 83.5 million acres planted figure. Again, if corn gets chopped down, lowered eventually in this acreage report by some amount, probably three quarters of that go to soybeans for increase, and the other to grain sorghum. And with grain sorghum being a kind of a Western Corn Belt phenomena. Ending stocks, the USDA projected large crop. 2020 production, 4.12 billion bushels, 405 million bushels of tighter stocks, 9.4% stocks to use. Prices about $8.20. So they tightened up stocks and they lowered the price. And that may be so. That may work out, but that shows what's going into the thought process. And I think they're very, very cautious given what's happened in all the financial and commodity markets, to saying there'll be much of a price on any ag grain. Would say, so again, 83.5 was a projection that USDA had, and so adding about 1.25 million acres onto the beans will get you that number right there. And projected a pretty healthy yield, but not as much of a record high as for corn. You can see the supply numbers generally, even with stock's supposed to be down some because of pretty decent demand, but still we're hanging around 4.7, 4.8 billion bushels total supplies. And you can see kind of where domestic crush and exports come into play, and the weakness of U.S. soybean exports in the midst of the U.S.-China disagreement. And so we got down to 1.6, 1.7, 1.7.5, and have recovered some in terms of projections going forward. You can see the pace of exports were stronger relative to other years up until about 2.5, 3 months ago, and have slowed down. That probably has to do with Brazil having a decent crop coming on. And USDA's projection, it's probably a good way to get headaches in life, to think about whether prices are behaving according to what we think they should in economic theory. But in this, if stocks to use really drop from 23% in 2018 down to 15% 2019-20, projected down to 9%, 9.5%, do you see, unless there's an outside factor coming in affecting things, and I think USDA would argue there is, normally you'd see a lot higher prices. Last time we were down towards 9.4, we were $1 higher. So I don't know what to tell our folks other than there's more than just supply, the raw supply demand involved in the pessimism with regard to where soybean prices are going. And so with that, here for soybeans, 820 is the USDA's projection. That second column of numbers for 2020-21, and you have to give them their due. They're coming in, and they have a bunch of constraints I probably can't dream of. And so they projected 820. When I look at those numbers, if I were to plug that into historic relationships, something like 850 to 880, and you come up with other scenarios, a little bit higher planted acreage generally, and now scenario 2 is higher planted acreage and lower yield. So instead of 49.8, basically 50 bushel acre, if you drop it 2.5, well, that's a whole different world. 6.3%, around $9 beans. But right now the market's operating on 50 bushel beans, and but that's, you can see from that, it's a pretty that's a pretty edgy, sensitive number. So there's my KSU projections. USDA projecting 820, thinking that by the time you balance out where these things really work at, that you're looking at 40.50 to 85 cents higher than where the USDA is coming in. And world supplies, these are almost the same charts. Just change the scale and the names in terms of no major shortfall in production coming in and hurting supplies, available exportable supplies, usable supplies for soybeans. Let's finish up with wheat. Strong milling demand for wheat. We've talked about this a lot here of late. Consumers' risk-averse response to COVID-19 is not quite as gangbusters as it was initially, but still a pretty strong response. As pandemic continues, likely strong domestic use will also, although it seems to be, as we get used to dealing with this, perhaps not with the same fever pitch. In terms of 2020 production ending stocks, if we have good yields, getting 50 bushels, well, we'll get at that in terms of, I think it's 51 bushel per acre, I believe. U.S. wheat production, 1.866 billion bushels. Ending stocks, 900 million, 44% stocks to use. Was 55 not long ago. Season average price, 460. And exports, pretty decent pace. A lot of excitement in the wheat market for most of the year. But it does seem that we're not ending as strongly as some of those better years, 2016, 17, and 18, 19. For hard red, we've had a decent year, especially at the beginning, near record-setting year, but have had a good year, but not, again, not a record year like those best of years. Stocks to use, USDA's projection, again, 46% stocks to use. 46% stocks to use in 2019-20, 44 in this year, and projecting no change in price. So generally, I'm looking at what would occur with U.S. wheat. It was 49.5 was the projected yield. If you take about 2.7, well, in essence, here's where I know we have a bunch of dedicated wheat growers on here. Louise Emke's on this. Vance will probably call me in next coming days and contend what I'm saying here. But we've had freeze damage, and I don't know that the numbers are accounting for all of that damage yet. we have drought, serious drought coming into the western third of the state, especially southwest Kansas, it would not be hard at all to see 100 million bushels shaved off of just the winter wheat production numbers. It's just off of that. Everything else being equal, just 100 million bushels off of winter wheat, given what we're facing. You know, you're down to 46. Well, that's 2.7 bushels per acre, and production gets knocked down some. Everything else unchanged. You go from 44% down to 39%, and not too much difference on the price, about 470 or so. And if you do the same type of situation and come in and add 50 million bushels on country by country, sovereign country grain hoarding or protection, if nothing else, you could see that. That's not unreasonable. And so here these are the numbers I need to put up. USDA projected 44% stocks to use, 460. If you drop to 39% stocks to use to 36, well, it's you're getting towards that tipping point edge in terms of those historic relationships to where you'd see a price response. So I'm not as bearish on wheat prices as USDA. Of course, when I talk about prices, I'm not affecting PLC payments and a whole bunch of other things too. So I could see why they're more cautious. That said, they seem to be pretty cautious in terms of their price projections for this coming year. And corn seems like it may not be low enough. Soybean seems like it may not be high enough, and wheat probably seems like it may not be high enough either. And sorghum may not be high enough, but it just came through COVID-19. Not through it, but the big shock of it, and they're probably pretty hesitant about making any bold proclamations. And world wheat supply demand. There's this last chart I'll show you. When you look at the aggregate world stocks to use, 41%, record high, never been there before. If you take China out, you're at 24%, and we're in the middle of the road. So I see this aggregate number, but it's not representing what's available in the market. What's representing what's available in the market is more like 24% stocks to use, and that's just so in terms of tightness or not. So that offers a little bit more hope on the wheat market. Well, thank you very much. I appreciate the chance to speak with you on this. Do we have any questions I can try to address? From Jermaine Marzin. With the tension between President Trump and China on COVID-19, is there any chance of corn and beans to have a slight bump up this early summer like it often has in May, June? Are you saying that tension may hurt the performance of the trade deal? One thing I've read on this, things could get so acrimonious that they throw all that out. One train of thought that I have read, and I think it makes some sense, is that really about the only place where the U.S. and China are still talking on friendly and constructive terms is in terms of trade, and agricultural trade is a big part of that. So I don't know that yes, there's a lot of acrimony and not as much of controlled diplomacy in our speech, perhaps, as some would like, but it's at least an area. Just within the last few days, U.S. Trade Representative and China were talking, and they both agreed that the rhetoric probably needs to slow down some. So we shall see. Okay, I got a message. Oops, a message from Yeah, Louise, you're talking about disease coming on. I would not be surprised. I'm not as up on that as I am the freeze and the drought issues. So drop me a note on that. If livestock producers move to using soybean meal instead of DDGs, does that move the needle on soybean prices? Well, it would not hurt. Let's see. I'm going to take a quick look at that supply-demand balance sheet. Let's see. So soybeans, domestic crush, domestic disappearance. The USDA's just in their May numbers, they did increase domestic disappearance of soybean meal by some amount from 37.1 million short tons to 37.5. So although I've thought about the trade-off between corn and DDGs, I don't know if it's a one-to-one. I just am not. I don't know how soybean meal and DDGs trade off, but it looks like from that perhaps that could be a factor that probably is represented in this new crop soybean meal supply demand balance sheet. Let's see, Shelley Yeager. So many ethanol plants have closed, maybe forever. How many will not come back? What effect? I think Mr. Cooper from Renewable Fuels Association is the person to ask on that. but I think I don't doubt that when they come back, it'll be, well, is this a flushing out of those that have high debt or inefficiencies? The ones that are going to come back are ones that can make money at low profits, at low prices. So I think without question, unfortunately, there's a lot of people involved when we talk about the efficiencies that are enforced by losses in the market, i.e. capitalism's creative destruction. But that said, what's surprising to me is the USDA came back, projected 5.2 billion bushels of corn, which is almost full ethanol production. And I agree with you, Shelley. Some of those plants aren't going to open. So are the others just going to double up? I don't know. But I would think any of them that weren't operating at the front edge of efficiency and profitability, whatever there was of that, are they'll be at the back of the line coming back on. That'd be my thought. Louise asks, so what about the value of the dollar and foreign buying power? Any comment on inflation, deflation? I said I tipped my toe into that just about as far as I dare do that. Brian, if you're listening, would you like to take that one?
Yeah, sure, Dan. So I guess when you look at the outlook, at least what the market is expecting on future inflation, the 5-year break-even inflation rate sets at about 0.5%. And then the 10-year break-even inflation rate sets at 1%. So at least at this time, the market does not expect any, rampant or, future inflation, really high, or deflation. Looking at the rhetoric coming out of the Federal Reserve, it's pretty much just continue to provide stimulus to get us through this period of time, which in some ways has me a little bit concerned. If you look at the money supply that we have, so measure of M2, so shorter term deposits like checking accounts, currency, as well as savings accounts, more time deposits, there has just been a significant increase in that. So that stage has really been set for quite a bit of inflation. But again, really that high inflation is too much money chasing too few goods. Certainly within our supply chains, we've seen a pullback, not necessarily agricultural, but outside of pulling back the amount of goods that we're producing. So there's definitely too few supplies, and we definitely have too much money. You look at that M2 money growth, it's just pretty shocking. Demand has just completely fallen off. Wage growth is not apparent at all. Borrowing and lending, everything has really kind of shut down on that end. So the stage is set for that. At least the market doesn't expect it to happen, that really, really high inflation that I think some folks are worried about. I know also too some folks questions that I get a lot of, well, what about all this debt that we are issuing as a government? Will what effect does that have? Well, I mean, we are making, some of the largest U.S. Treasury issuances that we have in history. Yet you saw the charts from Dan on the value of the U.S. dollar. It's still very strong. So at least everything right now where we're at and looking forward looks to be okay. But there are some definite challenges that could come up very, very quickly.
Thank you, Brian. There's a question, hard red crop equal to USDA's? Okay, how skilled of an economist am I that I could dance around this question? Here's what I think. We do have a virtual crop tour organized by Kansas Wheat, I think coming up early next week. So that'll be interesting to see. My thought is that the likelihood of damage from freezing temperatures plus the dry conditions coming in, which could trump anything else, are they're in position to work against that crop. My expectation would be that the USDA's number that they came out with probably will go lower, but it's a dynamic thing. We have to see if the drought persists and just how tough this crop is, and many people have lost fortunes betting on the death of hard red winter wheat crops in Kansas. I was around 1996. I remember when all that dead Jagger made 20 bushel an acre. So that can happen. Any estimates on the planned hemp crop in Kansas this year? Say, Rich, do you have any thoughts on that? Or I'll take a stab at that. I think the real issue has to do with market out. Am I wrong in thinking that we can grow it, but I believe we had some challenges in getting reliable outlets for sales. Is that a fair assessment of what happened this last year? I think we can grow it. That's we're very, very good at that. But do we have enough established outlets yet to have it to be all that much more of a relied upon crop? Let's see. How much reduction in Russia or EU crop does it take to make a difference to U.S. wheat price? As much as happened in the last two major droughts they had. And I could go back and find the exact years. I think it's 2010, 2012, or anyway, in 2 out of 3 years we had short crops. There's tangible short crops, and it affected the market. If you've been watching on that, it's more than short. It's a short crop. It's the worries of those countries and their supply chain. So there are major policy discussions in both Russia and Ukraine as to how much they were going to allow grain to be set out, and they went ahead and whittled their stocks down to not lose market share. So that we're looking at. All right, where are we at on questions, Rich? Greg Chrisick asked the question, some ethanol plants are finding a new market making feedstock for hand sanitizers and may shift towards the chemicals market for their mix of revenues. Won't be high volumes of product compared to fuel, but expect that to continue. Yes, that's been in the news. And there was good for them. It's an entrepreneurial opportunity. Okay. There's a question, Brian, did you see that one from Richard Crow? How much debt can the Fed take off balance sheet by printing money?
Yeah, I saw that. I did ask for a little bit of a follow-up, but I guess I'll kind of take the question and unpack it a little bit.
Okay.
So thinking about the printing money, so the Fed in this case, the printing money that they do isn't like thinking about firing up the actual printing presses and printing currency. Today's Fed, the way that they print money is by buying securities, adding it to their balance sheet. So at this point in time, at least the Fed, for them buying U.S. government debt, it's still pretty strong. I mean, they still have committed to being able to add that debt or an asset on their balance sheet. And be able to continue to do that. I guess The one where I'm kind of wondering about is just with the Fed creating so many these new facilities that they're creating to lending to corporations. They've even created a Main Street lending facility to where, you know, they are working with banks, the economy going forward. The best way that I would Fed bought back in the 2008 financial crisis, and what those securities were the bad home loans that were made on the coasts. So they were putting that bad debt onto their balance sheet. So fast forward here today, now we have these different lending facilities that are created. Well, who's going to use that facility? Like a lender, if they're making a loan to a different business, it's more than likely a little bit higher risk. And then they are going to pass it through and put it onto the Fed. Now, I don't know that for sure. That's just me thinking through, if, you know, I was considering using this facility, why would I want to use it? Well, one dynamic when you talk about not just government debt, but also just debt throughout the street businesses, that could have some ramifications when it comes to just distorting the marketplace and letting debt markets function properly.